Welcome, and thank you for joining us for our next webinar, Navigating the New Landscape, Strategic Tax Insights Post-Election. This is the second in a series of webinars that we're doing. My name is Brian Moore, and I am the National Managing Partner of Tax Services at Cherry Bekaert. In this webinar, we're going to explore the evolving congressional tax policy discussions, along with the budget considerations under the budget reconciliation process, and how they may influence pass-through entity taxes, and discuss potential shifts in estate and gift planning as well. I'm pleased today to introduce our other speakers. Ron Wainwright, who is a partner in our strategic tax group, Brian Dill, who leads our international tax practice, Mark Arrigo, who's the national managing partner for SALT, and Mike Kirkman, who is our estate and gift tax leader. With that, I will turn it over to Ron and let him take it away. Thanks. Thanks.
Brian, thank you so much. And welcome back to our second webinar, as Brian highlighted, in regards to the election outcomes, specifically focused on tax policy and the 2025 strategic insights that have occurred since our last webinar. So in regards to today, we are looking forward to the following. We will talk about where we are in 2025, recognizing the 119th congressional has sat. We'll talk about the state of play, as Brian highlighted specifically when we speak about the overall budget considerations, as well as budget reconciliation. We will touch on tariffs, and then one of my fellow partners, Brian Dill of International Tax, will go a deeper dive into Pillar 1, Pillar 2, where we see the OECD, and then some of the tariffs that we would expect on January 20th. Then one of my fellow partners will talk about state and local tax considerations and the SALT cap. Then another partner will talk about the estate and gift tax updates and what to expect in the 2025 year. So let's get started. And this brings us to our first polling question. Now, I will manage some expectations. We have a lot of information. So we will be not posting, but it is very important as you learn to make sure that you complete the polls. So how did you hear about this webinar? Cherry Bekaert Tax Advisor, email from Cherry Bekaert, friend of a colleague or colleague, Cherry Bekaert alumni, and then a social media post. So please make sure that you complete that. The poll will continue to be open for CPE purposes. So let's go ahead and get started out of respect of time and the information that we have to cover. So from an election result perspective, just to reset the table, now the Electoral College has been certified, where President-elect Trump will be the 47th president with 312 electoral votes. On the Senate side, we know from the first webinar that the Republicans won 53 seats, winning 4 seats, the Democrats losing 4 seats. However, currently the Republicans only have 52 because there is an open seat, given that one of the cabinet nominees, Senator or prior Senator Rubio, his seat has not been filled. But there is still a control by the GOP in the Senate, which, as we know, was a flip. On the House side, we know the Republicans won 220, but very similar to what we see in the Senate through cabinet nominations. The GOP or the Republicans control currently 218, with the Democrats controlling 215. Again, the Democrats won a seat and the Republicans lost a seat, just to benchmark. So now let's talk about the tax policy and the state of play. As a reminder, we stressed in our first webinar that obviously making the expiring individual income tax cuts from the 2017 Tax Cuts and Jobs Act permanent, or at least on an extended period of time, is one of the top priorities of the incoming administration to be inaugurated on January 20th. One of the reasons we want to talk about the SALT cap was there was a campaign commitment, but then some changes to it in regards to reinstating the unlimited itemized deduction for state and local taxes paid, or as we updated you, likely a new cap, not a total lift of the $10,000 limitation currently. Clearly, there were some items mentioned on the campaign trail around the exemption of Social Security, exemption from tax for tips, as well as the exemption from overtime pay from taxation. And we'll talk a little bit about those as we kind of go through what to expect in the first 100 days. Tariffs and trade, which we will talk about on this, as well as we have an upcoming webinar. There will be a deeper dive in the February timetable for you all in regards to tariffs. So remember, there was a universal baseline tariff that basically was discussed between 10 to 20%. That's still moving. We know that there will be 100 executive orders the afternoon of January 20th. Those will cover, obviously, some of the border matters, but there will be specific executive orders. The number we've heard is somewhere in the neighborhood of 60 to 70 in regards to tariffs. And of course, the imposition of potentially a 60% tariff on U.S. imports from China. So again, the extension of the Tax Cuts Jobs Act is a top priority. The Trump campaign promised with the current political momentum that this will happen expeditiously, as well as that there was a mandate to this. One of the reasons we wanted to go back and review where the Senate is and where the House is there are very narrow margins. This will give various representatives or senators a significant amount of sway as they get into what is referred to as budget reconciliation. And this was evidenced in the Friday speaker vote by the House of Representatives in electing Speaker Johnson, where you saw on the first ballot, he only reached 215, and then 3 changed on the Republican side to get him to the 218. The most critical thing to keep an eye on, as we've mentioned previously, is to pay attention, and we'll talk a little bit more about this, as to where the Republicans are willing to add to the deficit increase. The tariff piece is also equally important, as we mentioned, in regards to what are referred to as pay-fors. These are, in essence, statutory tariffs, and we would expect a repeal of some of the Inflation Reduction Act green energy tax subsidies that are likely to occur in regards to more of a leaning towards oil and gas. But the pay-fors are important, as we've talked previously, in regards to the budgetary measures. Addressing state and local tax issues is going to be very, very challenging. And Mark, who is our national SALT leader, will be talking about that on this presentation. And so that is a significant challenge, specifically when you think about the narrow congressional margins. Brian is going to cover the OECD that we talked about in webinar number 1 and Pillar 1. We know that there is likely going to be some strong retaliation against what are referred to as digital services taxes. And then there's likely going to be this fight over under-taxed profits rule under Pillar 2, if that is adopted, which it is likely not to be adopted. So these are some of the key reasons we wanted to have these speakers today. So let's talk about the path forward. So just a reminder, it will come underneath budget reconciliation. Why? That means that the Republicans on the Senate side specifically have to pass with only 51. As we've identified, they sit at 52 and will likely sit at 53. There's a number of reasons for that. And just a refresher on budget reconciliation, it all starts. The process begins with the chambers passing an identical budget resolution, which outlines the spending and the revenue goals for the specific committees to target through the reconciliation bills. And then skipping forward to the limited debate in the Senate, remember that's the budget reconciliation process as well, which is the key vote of 51. And remember, the Byrd rule also is a strict rule which limits the amount of filibustering that it could occur in regards to the Senate passing a bill. So that's really kind of just the key things as a reminder of where we sit today and where we've gone through an evolution. There were questions of whether Speaker Johnson would maintain his speakership, which obviously he did on the first vote, but that was a lot of back and forth, and President-elect Trump was involved actually during that vote to encourage those three that ultimately moved their vote to support him. So currently in the 119th Congress, we have Senator Thune. He's the Senator Majority Leader. He took over from Senator McConnell, and he was groomed underneath Senator McConnell. As we know, Speaker Johnson won on the Friday vote several weeks back the speakership. The tax writing committees, as a reminder, and these are individuals that we want to pay close attention to as we go through budget reconciliation, and we'll update you on things that have already occurred. As regards to Senator Crapo, Senator Crapo now chairs the Senate Finance Committee, as well as Chairman Smith, who chairs the House Ways and Means Committee. But remember, Chairman Smith was there in the prior 118th Congress, a lot of experience. Both of these individuals since February of 2024 have had their respective committees, in the minority on the Senate, but the majority on the House, basically working on what will it take, what does it need to occur to pass the Tax Cuts Jobs Act of 2017. A lot of those provisions, as we all know, expire in 2025. Wanted to give you a little bit of update here because this is interesting. We do have 4 new members of the House Ways and Means Committee. Those are the bottom 4. So when you think about Representative Yeckham and Representative Miller and Representative Bean and Representative Moran, those are 4 new members to the committee. Remember that the committee is in the majority at 26 to the Republicans and the minority, if you will, to the Democrats. So of the 45, the Republicans ultimately control the majority there in the House Ways and Means. So on a straight party vote of 26, that is likely that piece of reconciliation would pass relatively smoothly. It's going to be very important as an update to pay attention to these. This was only named last week. Underneath the House Ways and Means, you have subcommittees. So pay attention very closely and to Mr. Representative Kelly, who chairs the subcommittee on tax. And the other one to pay attention to is the subcommittee on trade, which is chaired by Representative Smith. The last one to pay attention to the prior slide around some of the campaign promises, is with respect to the subcommittee on Social Security. There's already been floated some ideas surrounding Medicare specifically, as well as Social Security. So let's pay attention to that as we begin to think about tax legislation, tax policy, and ultimately the budget reconciliation. So this is the key slide for you to focus on. What is the current state of play? And this is updated literally as of yesterday. So a couple things to take into consideration. We know that in the December timetable, then Secretary of Treasury, now still Secretary of Treasury, Yellen, indicated that the debt ceiling of the United States, which is approaching $37 trillion, would be hit between January 14th through the 23rd of this month. And then that's when the Treasury would need to begin to take what they're called extraordinary items to control the deficit, if you will, the debt ceiling. We know that the continuing resolution, and yes, that was the 5th continuing resolution that was passed in December to continue to keep the government running, expires March 14th of 2025. Now, Speaker Johnson over the weekend came out very strong, as well as Senator Thune, in regards to whether there was a debate. We updated you on that in the last webinar between, are we going to have one budget reconciliation process, in essence, one bill, or are we going to have 2? Remember, the key there is that literally you can pass legislation on the House side as well as the The Senate side due to majorities. But again, that's where that small majority comes into play. The reason they want to go to a single reconciliation bill with a target date of delivering that bill pursuant to Speaker Johnson over the weekend, as well as in a press release yesterday, they want a single reconciliation bill delivered to the Senate on April 3rd. So there's a lot of work to be done to get that bill over to the Senate by April 3rd. The general view is that will be border security oriented because all border security cannot be done by executive order. They're going to address the expiring Tax Cuts Jobs Act provisions, and then, of course, increase the nation's borrowing limit spending cuts. So that's a key date there. Remember, March 14th, and remember April 3rd. So there is likely, to my comment, going to be another continuing resolution, which ultimately will continue to fund the government beyond the current funding through March 14th. What was announced was that the Senate would vote on the quote piece of tax legislation by the end of April or the May timeframe. They want to adopt a budget resolution in the reconciliation framework so as to really be able to fill in the legislative details by early February. So what does that mean? You're likely going to see on the House and Senate side an agreement as to what the budget, or in essence, the cap, is going to look like within the reconciliation framework. Then the committees that have been working since February of 24 go to work to, in essence, fill in all those legislative details. And that is expected to be accomplished by early February in regards to an understanding on the GOP side is what they're willing to increase the, in essence, debt limit to. And that's where the tariffs come into play. On a post from President-elect Trump, he highlighted very specifically that ultimately the Republicans needed to unite to work quickly on one powerful bill as opposed to two. So that has really been accomplished. On the tariff update side, my partner Brian's going to go into more around this, but I just wanted to make a couple comments. And so remember that we are in a global trade imbalance. So ultimately, the current trade rules incentivize flow of capital away from the United States, where it's really most needed and most productive in regards to make America great again underneath President-elect Trump or his policy position. We know that there's other countries that are going to potentially retaliate. And we know that countries subsidize production, specifically in the industrial trade policy. And this just gives you a highlight of how that's accomplished between country A and then ultimately the US consumer. And we saw over the last 10 years, US manufacturing, as well as other services, were being offshored and then subsidized by that country A. Brian will talk more about that. The ultimate global dynamics that we would expect is, again, we're hearing 60 that are going to be, quote, tariff oriented, is predominantly, these are the straightforward ones. We'll see what happens on a geopolitical basis, but Canada and Mexico propose at 25%. China, 35 to 60%. But as I commented in the first webinar, we're hearing more in the 45% range there. So there's already been negotiations that have occurring prior to the inauguration. And then, of course, Brian is going to talk about the OECD when we talk about the EU and some concerns about retaliation by the World Trade Organization. He'll also go into more detail on tariff engineering, contract negotiation, and then other strategies that we need to begin or have you all begin to think about. At this time, I'd like to turn it over to Mark, who's going to talk to us about one of the key areas in regards to SALT cap considerations. Mark?
Ron, thank you very much. I guess the real question we all probably ask ourselves today is, hey, we're all sitting around talking about the SALT cap. Who would have thought that would have been the key item in this whole discussion of, the revenue raiser that was used back when TCJA was enacted as a significant piece of it and where it is. So let's kind of refresh on how we got here relative to where we are with the SALT cap. So when TCJA came around, before it, individuals could itemize their state and local tax basically to the full extent. What happened is there was a cap put in at $10,000 with regards to state and local taxes. And you look at that, and in effect, it's going to be in effect all the way from 2018 to 2025. And then when you roll into 2026, it would basically revert back. So in essence, it would flat disappear is where we kind of stand today. Now, the IRS, and this is really for those who are curious of how did we end up with all these pass-through entity structures? And the IRS issued a notice. And the notice came out in 2020. And basically they said, hey, yeah, the states have the opportunity to create a system that allows the deductibility of certain state and local tax payments through the pass-through entities. And that went around full circle. The interesting thing is the proposed regulations from the service never came about. So in essence, the IRS basically acquiesced to the idea, but they've never documented it from that standpoint. So what do you have in the state arena? You have 36 states plus this New York City all have some type of pass-through entity tax capabilities. And they're all in varying degrees of complexity. They fall into two significant buckets, and you're always going to hear it talked about as a credit method or an income reduction method. And in essence, that's where we are today. So let's kind of get our crystal ball out here and let's talk a little bit about what we think we're going to see, with regards to pass-through entities and that piece moving forward. We believe there really are three key scenarios here that are to be considered. The first scenario is probably not the scenario anyone wants to hear. It would be the SALT cap would sunset, which would mean, the cap would go away. Now, I will say this. There are a number of states that will have pass-through entity structures even if it's sunsetted. And there are some potential benefits to that. Think minimum tax and some other areas. However, in our opinion right now, this is probably highly unlikely. It's very clear President-elect Trump and Congress is working to come to some type of resolution around this. However, as Ron alluded to, we have razor thin margins around the voting component here. And some Republicans in blue states are really kind of pushing hard to look at where we can go. So let's go to the next one. We just get an extension of the current $10,000 limit. That appears to be highly unlikely in today's world. This was part of what President-elect Trump campaigned on. The states have workarounds on this. So, some of the benefit is getting to taxpayers. Most of that benefit, it does come with some complexity that goes around it. So there aren't that many states that don't have pass-through entity taxes at this point in time. So the real crux of the question is, and this is where the push and pull is in today's landscape, where are we going to end up? So scenario 3, as we look at it, is probably the more realistic of where we're going to end. Now, if you go back to scenario 1, just thinking about it, if that happened, that would be over a 10-year window in the $1 trillion range of having to fix that number. So the sunsetting is an unrealistic answer. The staying at 10,000 with all the back and forth movement on that is probably still somewhat unrealistic. President-elect Trump asked for a number. And so you got to believe something's going to happen here to deal with this. But there are a lot of things going on, a lot of revenue that this would still have to be raised in order to take into some of the other aspects of the campaign focus that President-elect Trump put out there. But our feeling is you're probably going to see something move, and I don't know if they'll also look at the joint filing piece of this as well, because that's not taken into consideration on the cap. But that's really where we think we're going to fall out in the future landscape today, is probably more in scenario 3, as we come together, we try to get something. And, at some point, once you get above above the 50,000 threshold, you start to get a de minimis return of who gets the benefit. And that's going to be an optical issue that I think Congress will have to deal with on, hey, are most Americans going to need $50,000, or is that not the case? So there are a lot of aspects of this. There is no perfect answer. I think we'll get the answer, as Ron alluded to, as we start to get ourselves set up for where we're going to go. But something is clearly going to happen with the SALT cap. And I think this will be very interesting to watch and feel how this moves along. And I'm sure we'll move to this moving forward. So, Ron, I'll turn it back to you as we give it over to Mike to talk estate and gifts.
Very good. Thank you, Mark. Excellent insight. Mike, let's talk about estate and gifts and the updates. But I think we have a polling question here, if you'd like to go ahead and read that for our attendees.
Are you regularly meeting with an advisor for estate planning and gifting? Yes, a little, or no? We're going into the estate tax exemption realm. We have never experienced as high of an exemption as we ever have currently. Right now in 2025, it is at its highest level. Now, you'll see 13.99 million per individual. That's U.S. resident and citizens of the United States. So I'm not sure why Treasury just did not round that up to 14 million to make it easy to say, hey, husband, wife, you have 28 million. But currently we have husband, married couple, 27.98 million per couple. And that came in with the 2017 Tax Cuts and Job Act. Again, it was indexed to inflation, and if that continues, it's only going to get larger. Future projections, what I would say with regard to the estate and gift tax exemption is that it's either going to be frozen at the current level or it will continue to go up. Just to give you a little context of what the estate tax raise really is. In 2023, the Treasury reported around $34 billion in revenue. And in 2024, they're anticipating that to drop to about 33 billion. And over a 10-year period, it's expected in 2034 to be around 66 billion. Next slide. So that in the scheme of things, while billions of dollars is a lot of money, it's not large in the context of a revenue raise for the Treasury, but it is a political hot button. Just what we anticipate was going to happen in 2025. If nothing happened, very similar to the SALT cap, it was going to be unlimited for state and local taxes. For the estate tax exemption, it was going to revert back to the 2017 level, which with inflation would put it around 7.5 million. So you're basically cutting this in half, which means a lot more taxpayers are going to be filing estate tax returns and paying more estate tax. So you would have that threshold that would come into play. And a lot of folks have been doing a significant amount of planning over the last several years of making transfers to use up that high level of exemption. I think we need to continue to do that kind of planning, but as we move forward, it looks very likely that the tea leaves are indicating that we're going to have not a reduction in that exemption. And so when you're looking at this type of planning with regard to the estate and gift tax, especially for a large number of our clients that have closely held businesses and they want to keep that succession within the family over a period of generations, it brings a tremendous opportunity for folks to make these transfers and utilize this high level of exemption as they move forward. I would strongly encourage anyone out there that has an estate tax either within this window or even within the window of where it was going to reduce back to in 2026 with the sunset, that keep in mind that President-elect Trump's only going to be in office 4 years. And as we all know, administrations change and tax policy ebbs and flows a lot more than it did 30 years ago. So we could see a change. So continuing to do estate and gift planning is very, very important in light of that. This is not going to be probably something that's going to be permanent long term. And with that, I'm going to turn it over to Brian to move into the international tax update on Pillar 1 and Pillar 2.
Thanks, Mike. Can we forward the slides to slide 38? Thank you very much. Let's go to the next slide. I think we have a polling question to start us off with. How do you feel about potential changes in international tax policies? I feel good about proposed policies. I feel unsure, not sure, hoping to learn more, or I'm not concerned. Right. Let you answer that, and we'll go to the next one. So today I'm going to talk about the OECD initiatives and a little bit about tariffs and how you should start to plan for those and maybe some things you should be doing within your company or organizations to plan for tariff changes. The big thing on the OECD pillars to really think about this is that is a global organization based out of France that has come up with new initiatives to what I will say perceive level the playing field on a global basis. And so you might think that countries that are advocating this tremendously tend to be developing jurisdictions, and certainly there is a heavy EU lean to this. I think from a US perspective, Treasury and companies here have thought that it is unfair to US industry, especially the technology industry. And the OECD's pillars are really organized along two pillars. Pillar 1 is really changing where companies pay tax. And that means that, you know, if it'll be more consumption oriented, so that if a technology company, for example, is developing new technology here in the US, but the ultimate user of that technology, even though the US technology company has no footprint in that foreign country, the US technology company would end up actually owing tax in that foreign country. And then the other thing is, as a backup, are digital services taxes. That's the main part of Pillar 1, and that's what is known as Pillar 1 Model A. And then there is a component called Component B, and I'll talk a little bit about Component B. Component B is supposed to be a streamlined initiative for transfer pricing, and I'll give you a little update about that because the IRS did issue a notice on that recently. Pillar 2, I'm sure you all have heard about it, maybe in different words. It's really the global minimum tax at 15%. And that's really the two, changing taxation to the consumer, really on technology, and global minimum tax. Next slide. An update where we think Pillar 1 and Pillar 2 are here in the US. Pillar 1, as it applies to Component A, I'll talk about Component B in a minute. we think is dead. Even under Biden, it was barely under on life support. We certainly think Pillar 1 is a non-starter. And as a non-starter, the one part of Pillar 1 is it takes, I think, 30 countries to agree to this, including certain major countries. And so with the US not signing on, it is widely anticipated that Pillar 1 will kind of sort of die on the vine, and we will not see Pillar 1 implemented, at least for the next 4 years. Pillar 2 is the global minimum tax, and I think Pillar 2 could work to be disadvantageous to the United States for bringing manufacturing back in the US. You know, you could go with the President-elect Trump's idea of a 15% tax for manufacturing, the idea of having additional incentives like R&D potentially, or bonus depreciation could certainly drive companies' effective tax rate under 15% in the United States. And so what that would mean, let's take a UK company coming into the US and taking advantage of the incentives here in the US and paying a tax less than 15% on an effective rate basis. Well, that would mean that they get no benefit of it because they would pay what is known as a top-up tax in the UK for that delta below 15%, so that the company would be disincentivized from moving operations into the US. We think this could be a negotiation point for the new administration as they go down the tariff route, and to see, could there be some bargaining with regard to this, you know, undertaxed rule or global minimum tax and top-up tax? Could we see some negotiation around that point there? Next slide. One thing on Pillar 1, even though Pillar 1 will likely be dead, Treasury has, you know, signaled the idea that they want to align with Component B. Component B is really a simplification of transfer pricing, primarily for marketing and distribution activities. So for global companies that have a distributor vertically integrated in a particular country, they want to streamline the intercompany pricing and documentation on that. And the US wants to align with that. They've come up with their own rules about how to do that. And it would be known as an election for a streamlined and simplified approach, or what the acronym is going to be in SSA. You know, based upon my reading, for mid-sized companies coming into the US with distribution activities, or going overseas with distribution activities and wanting US transfer pricing, you know, I think there's a big question based upon my reading of the proposed regulations, whether the administrative requirements really outweigh what I call the simplification piece, because there, as always, once government gets into it, and Treasury did, there's a lot of administrative and documentation requirements that go along with it. So yes, there's a simplified component for coming up with an operating margin, but the paperwork around it could be cost prohibitive for some clients. Next slide. President, now I want to talk, you know, I think it's hot in the news on the tariff side. So we have Pillar 1, Pillar 2. Pillar 1's dead on the vine. Pillar 2, I think, is a negotiation ploy, or could be a negotiation point. What can the president do from a president? You know, what could he want to do, and what could we expect him to do? We think, you know, some of the things he mentioned during the campaign included a 10 to 20% tariffs on all imported goods. So that would be that any country could be subject to a negotiation on their tariffs. Ron mentioned earlier the large impact on China on the 60%. I think everybody, you can see in China, they are trying desperately to increase their domestic consumption because they believe there's going to be some retaliation via via imports here into the U.S. Just from a background perspective, the U.S. makes up almost 31% of the global consumer market. It's the largest consumer market, bar none. There's no one even close to it. So everyone wants to access the US market. And I think the Trump administration believes that puts the US in a much stronger negotiation point of view because of the idea of wanting to access it. I think you see that in the automotive industry and Germany. They're concerned about accessing the market here. Certainly, they do have manufacturing facilities here and they are integrated here, but certainly a big part of their um, uh, lineup, shall I say, is still made in Germany, especially the higher end models. So that could be very costly there. I think we could see an increase on export controls and sanctions on China. I think to pay close attention, not just on China, but export controls and sanctions. I think you've seen that with the Biden administration on AI. I think you should look to be very careful on what export controls and sanctions could be coming through. The other one I'll skip down is really the renegotiation of the United States-Mexico-Canada agreement. I think you've seen a lot of back and forth on Canada and the mention of the 51st state. We really believe that bullet point on the renegotiation of that agreement. I think those are the early barbs at renegotiating that agreement from that perspective and accessing the energy, the oil and gas in Canada, and how that'll work out. So I think those are the big things to take into account from a presidential trade power perspective. Next, presidential actions that we think that he could use. He could use his tariff authority under Section 301. He can certainly use executive orders. He can use sanction and embargoes. And like we know, like I mentioned on the Canada deal, the trade agreement, we think that that will be on the table to renegotiate. He can go for fast track. And of course, trade enforcement, that could be ramped up also. I think you see that with immigration. I would not be surprised if trade enforcement also goes along with that. Next slide. Well, what do you do now? What are the potential impacts and what should you be doing at this point in time, given that we're a few days away from the new administration and things can be rolling? What can you do to get ready to prepare for these type of negotiations and how they impact your organization? I think stating the obvious, decreased profitability, tariffs and inflationary rising material costs will directly impact your margins. Your ability to pass that through to your customer shall remain to be seen. How much can you pass through? What kind of appetite does the consumer have before they just don't make elective purchases, or they reduce their, what I call mandatory purchases that they have to have? What's going to happen in our supply chain? We certainly saw big supply chain disturbances during the pandemic. How have you changed? Do you have parallel supply chains? Do you have alternative supply chains? Are you ready for these tariffs coming from anywhere? And how flexible are you within your supply chain? Reduce market access. I think we're going to go ahead here. Preparing for trade policy developments will go on. I think this is a very important slide. Preparing for these, I think you all should be looking at and certainly discussing with your advisors what items are covered within the trade, which ones could be subject to tariffs, what could be the restrictions on purchase and sale, and what kind of costs could be levied on that. I think that's going to be a very big deal for those companies that are ahead of the game and know where their potential issues are and how they're, and then developing a strategy around that, I think will be very important. Where's your policy scope and exceptions and exclusions are going to be important. When do the restrictions or levies begin? I think that's going to be important from a policy perspective. Once you read about a new levy or restriction coming in to play, sometimes that can have a 3-month, 4-month pause before they actually change. So being ready to know when these new trade restrictions are announced, are you prepared to advance, buy more goods or whatever it might be? If you're heavily involved in your lobbying, if you're involved with your congressman, whatever it might be, to communicate your concerns and how it impacts you as an organization, and especially how it impacts you with regard to employment and growth here in the US. I think people are very willing to listen to that. And then for cross-border companies, what is that going to look like from a countries? Are they going to retaliate? How could that impact you in accessing their markets? Next. I say understand your current operating model. Who are your vendors today? Which countries, materials, products, and services? And also, I think a very important component here is how does the title of the goods flow based upon third party and intercompany contracts? We see a lot of times that companies do not actually know where the titles of the good flows. They don't really know who has title when it enters into the US, where that changes. So that's very important, especially from a financial side of the house, to understand those legalities, because that can have a very big impact on your ability to be flexible. And then, of course, vendors and origin of materials, and that opportunity to maybe change the origin of materials. It's beyond the scope of this conversation, but certainly something to discuss, and who your vendors are. Potential cost, really quickly here. How are the materials and goods currently categorized for customs purposes? Very important. How is it falling under the harmonized code system? Can you break it up? Can you fall under different harmonized codes that might be protected? And what is the cost difference on that? It's going to be a big deal. And of course, always, how does that affect your quality of your product? Next slide. Start thinking about assessing procurement and production alternatives. Think about, if this is going to be very costly to you, what are your alternative sources of materials? Do you have a procurement group, a purchasing group? Are they looking for alternatives already? I would highly recommend that your purchasing or procurement group really be on the phone and searching for opportunities for alternatives to your materials and products. And then continuity plans. Anytime we are talking about trade, it creates disruption. And how can you manage that for your customers to mitigate that disruption? We saw it during the pandemic. Certainly, we could see disruptions from tariffs in this case. Next. Immediate actions to consider, I think, is very important. Think about increasing your inventory, what I call preloading. Can you relocate your production, or do you have alternative sources for production? I know that's a longer term issue, but certainly things to start to consider, because it is such a lengthy decision tree. And thinking about what's the flexibility to passing on costs to consumers, and how you can do that. That can be done in a variety of ways, but starting to consider that. Customs valuation planning. How are the goods valued when they come into the US? Can you break them apart? Can you move assembly operations here in the US and get a better valuation? Because with assembly and packaging, maybe that changes the customs valuation dramatically. That will be very important. And I highly recommend lobby and advocacy, because it will be such an important component for so many companies here in the US. Next slide. Very quickly, strategies, tariff engineering. Just to talk about what we just talked about, tariff engineering involves strategic design of your supply chain and production processes to have a more favorable tariff. So if you're talking about 60% coming out of China, how is that going to impact you? Can you decrease, if you're going to have things coming out of China, can you decrease the cost structure of that, or the valuation on that component by breaking it apart? You know, a lot of times 60% on a $1 part, not a big deal, versus it's going to cost you $1.95 to move that production elsewhere. Country of origin, there are tax incentives in different locations to relocate production and have key processes, I think is something to start to look at. And then, like I said earlier, product reclassification, what I call changing the harmonized code for customs purposes. And can you change materials or specs so that you can fall under a more favorable harmonized code? Next slide. Contract renegotiations. I think tariff pass-through clauses allow the cost increases resulting from new tariffs to be shared or absorbed by the parties. Renegotiating those could be very important. And we saw this in the pandemic. A lot of times, the force majeure clauses in a lot of contracts were, shall I say, a little weak. And that is very important to think about. What are force majeure events? Do certain trade tariffs, if they're large enough, could they qualify under pseudo force majeure? Something to be considered. Next. Final thoughts that I have, stating the obvious here. Trade tensions are escalating. Everybody is on all sides ready to engage in discussions around this. They all know it's coming. We just don't know what the end result is going to be. We think the next 90 days is going to have a lot of insight around that and what might be coming out of that. So just pay close attention, and we'll see where it goes. And then I think, what can you do? Everything I talked about today was prioritizing agility to the point you can and minimizing disruption for your customers. You know, this could be a big deal when we have these trade interruptions, and how that could impact your businesses. Just internally, how are you preparing yourself for those things? And then I'll turn it over to Ron.
Thank you, Brian. Excellent insight. Much appreciated. Which brings us to polling question number 4. Would you like a team member to reach out to you after this webinar to do a deeper dive, learn more in regards to the topics that we discussed today, from the standpoint of whether it be the SALT cap, whether it be the estate and gift tax considerations and the planning, and then ultimately the tariff side. So we'll give you a little bit more time to respond to this poll, knowing it's the last poll. I will go back a slide and remind you that we are going to do a deeper dive post January 20th. That webinar will be in February. We're actually going to do 2. One is going to be a deep dive into tariffs. And so I would remind you that the reason we spent time on the tariff side today is that the tariff is a pay for. And so, as I highlighted in slide number 8 to you all, a pay for actually in the context of tax legislation, when the CBO scores, or the Congressional Budget Office scores that bill over a 10-year period, tariff can lower the tax cost specifically of that piece of legislation. So tariffs are going to be very important. And as I highlighted, we're hearing upwards of 70 tariffs potentially on the afternoon of January 20th, or even into that morning session. Do always have a disclaimer here in regards to the comments made. This does focus on President-elect Trump's proposal plans. It's general information of where we stand today, what is the state of play from what we know, but we will know a lot more post executive orders, post some of the things that we will expect. And so going back to the slide that I highlighted to you, the state of play, which is slide number 17. There's going to be a lot. Speaker Johnson, again, over the weekend on Sunday, commented that this is the calendar. He committed to deliver a single reconciliation bill to the Senate by April 23rd. It'll be border security, expiring tax cuts, and obviously to the budget reconciliation and just where that process starts. There'll be a borrowing limit as we now are approaching $37 trillion. So I, on behalf of Cherry Beckert and specifically Brian Moore, want to thank you for our webinar attendance today. Thank you for joining us. Again, if you have any questions, please reach out to us at any time. My contact is there. If it's an international matter, Brian Dill, a SALT matter, Mark, and then a estate and gift matter, Mike. And so we are thankful for your participation today. We hope it was informative for you. Again, the next 100 days, starting on January 20th, are going to be interesting from a tax policy, a tax legislation perspective, and our overall country. So stay tuned to those webinars. You'll be seeing those in the February timetable, and we look forward to updating you. So this does conclude for today, and everybody have a great day. Thank you.